I frequently get requests from new traders about where to begin. They're so confused with all of our tools, all of our different training videos, all the different ways of trading using our software. Where to begin? How do I first start? What's an easy way of learning to trade? A good system that I can start with and learn very quickly, and then learn some of the more sophisticated, more advanced trading methods over time, and also learn the contextual aspect of trading. For example, we always show the currency meter. You want to buy the strongest, sell the weakest. But after a currency's up 4 days in a row, it's probably more likely to reverse. Same thing with our upper 3.0 containment band. If it hits that level, it's much more likely to reverse and continue. There's not many likely pips. The risk versus reward ratio at the top or the bottom extremes is not very good in trading with the trend. So therefore, you're better off usually doing counter trend. There's a lot of advanced things that new traders need to learn over time. There's usually 50 to 100 things they don't know, and they don't even know that they don't know. That causes most new traders to take losing trades that I would never take and other experienced traders would never take. We also would ride a trend up, get out of our trade, flip it, and ride it back down under certain circumstances, whereas the new traders tend to want to trade in one direction. They are nervous getting out of a trade that makes them money and immediately flipping and going the opposite direction. It's counterintuitive, I think, on a natural level, and many people, until they've traded for a number of years or have a lot of experience doing that, feel very uncomfortable doing it and don't do it. Then they watch it fall 30 or 40 pips after it went up 80 pips, and they wish they had taken the trade. But nonetheless, this video, and I'm creating a new category called, basic or, beginner traders methods. So I'm going to create a new category for a Forex class called Beginning Traders Methods. And it's basically going to show very easy ways that you can start trading within a day or two and fully master, and then you can add more advanced methods to what I'm going to teach you today, such as support resistance, previous days high and low, weeks high and low, months high and low, daily pivots, weekly pivots, monthly pivots, and so forth. So one of the easiest ways, I think, of trading is using our currency meter. It's incredibly powerful, and whether you're a brand new trader or you've traded for 30 years, that will really help you in your trading. First of all, this one we released about 2 weeks ago, and it only works live. When you first bring it up on your chart, it starts showing the real-time strength or weakness. This is using the build your own trend currency meter on range charts. The more active the market is, the more bars there are, the more intuitiveness that you have in here. And you can see the yen went up quite a while and had incredible intensity. Anything at and above the 80 level, then it's green, it's strong. Red, it's weak. Underneath that, we had the percentage of currencies trending up above the 15-minute bars moving average, the hourly bars moving average. Underneath that, we had the daily, weekly, monthly trend. So trends change first on the real-time trend, then on the 15, then on the hourly, then on the daily, then on the weekly, then on the monthly, most of the time. Every once in a while, a weekly might change before a daily just based on where it is in its range, but that's 80–90% of the time the way trends change. So when you see a yen that's extremely strong today, and the dollar is also strong, but not nearly as strong as the yen. The dollar has the majority of currencies underneath their hourly moving averages, for instance. The daily trend's down, the weekly trend's down, the monthly trend's down. The daily trend's even more strongly down than the weekly and monthly trend. And all the time frames for the most part of the yen are up. So trade the yen against the weakest one, the New Zealand, on all time frames. And also the euro, for the most part, is weak on all time frames. Here's the euro yen, and this is a 5-minute chart. You could use a 5-minute chart if you wanted to, or you can use range charts, which I recommend and which I primarily use myself. We have a function under add script called ATR, average true range, and most people trade between 3 and noon, 3 a.m. and noon Eastern, and this basically sums up what the average volatility is on whatever time frame bar. If you like 5-minute bars, this helps you come up with a good number of pips per bar to use for range charts. The average is 4.65, the median is 5.3, so basically in a nutshell, you can use 5 pips per bar. So instead of 5 minutes, you hit 5R for 5 range chart, hit enter, and it's going to download tick data and create the range bars. Okay, so here is the range chart, and there's a lot of different methods that you can trade using range charts. I personally love range charts. I am deeply in love with range charts just because of how beautiful and clean they are. This is a 5 pips per bar, and so every time there's the euro yen moves 5 pips, there's a new bar. 5 pips, new bar. And what's beautiful about it is you can trail your stop. If you sold this, wedge pattern right here, you can put your stop right above the high and move it down either above the previous bar's high or 2 bars back. And anytime it kind of goes sideways, you can, move your stop down. And you can, a lot of times, especially after 3 to 8 bars up, the first bar that goes red, usually you can sell this with very low risk. Now, obviously, this has already moved a tremendous number of pips. If you short it right near the lows, your odds of a trade working is much less. I personally prefer, drawing trend lines underneath bars and waiting for that to get broken. Or you can use our Elliott 2-wave system, which basically means once you have a nice trend down, wait for 2 waves up to look to go short. This is the first wave up, pull back a little bit. This is the second wave up. This also has the 3 bars up in a row, 1 red bar. After a deep counter trend move like this, you're much more likely to catch a nice high pip move. So you would just simply, let's get rid of these fibs right here, put your stop right above the bar's high, and you would enter just when it goes 1 pip underneath that previous red bar's low. And this is, basically this is one of 2 different methods, both giving a entry signal at the same time. So the more of our tools and trading methods that you learn, when you see 2, 3, and sometimes 4 systems all saying to buy or all saying to sell at the same time, your odds go way up. Anytime you see a strong trend like this and you get a decent pullback, I would say at least 15 to 25 pips, the odds increase that at the very minimum you're going to break even on the trade. So once it starts going your way, typically 5 to 10 pips, I move my stop in half, and a lot of times trades don't work, but you don't lose the full 6 to 10 pips, you only lose 3 to 6 pips. And when it kind of is going down like this, you can just keep dragging your stop down. You might have got out of this trade right here with a small 18 pip profit, 16 pip profit, and it breaks down again. We don't have the particular currency meter on this because it only works live. But nonetheless, if you sell this low right here, normally we wouldn't do that. It's a relatively riskier trade. It's not nearly as good as this one. If you had our trailing stop on here, more than likely it would have kept you in. But if you are going to take this trade, at least you can draw your fibs on this last little wave, and if it stalls at the first one, you get out of half. If it shoots through the first one, usually want to get out of the second at the 1.618 fib target. And again, if you short near the extreme low, like here you have 4 or 5 bars up, 1 red bar, it's down so much that it's much more likely to reverse. And so that's why we use containment bands on our charts. So let's add another indicator and go through this. I'm not going to go through every one of our tools in this session, but I do want to show what these things do and why we use them. So we have the 1.5 band, the 2, and I also put on the 3. The 3.0 band rarely ever gets broken, and I color that green. When it gets to or below the 3.0 band, it's not likely to continue. As you can see, it touched it to almost a pip, and then it reversed. So one of the reasons why you wouldn't want to sell this, you always need to think in your mind, what's the odds of this trade working? If it's already gone too much, the odds go down dramatically. If you don't have enough pips to justify the risk, it's also not worth taking. Now, if this were to continue trending down, it's likely to go down to this green level. Let's just look at that as 106.50. So if you sold this at 106.63, you're going to risk about 10 pips to make 13 pips. You don't want to do that. You want to make at least 1.5, and if you're a new trader, because you're going to have a much lower winning percentage than an experienced trader, you want to shoot for 2 times bigger profits than what your risk is. That would add to your probability. So use the containment bands. Most of the time on my own charts, I don't use the 1.5 band because it shoots through there all the time. Usually the white 2.0 band, that's the color I like to make it, and the green 3.0 band. At this level right here, it's actually a relatively high probability counter trend trade. And what I myself do is when it gets down to that level, I don't have the real-time trend tool on here, but I'm looking to buy it as soon as it goes above the first green bar's high with my stop right underneath here. And typically it's going to go up at least 2 waves. So you can get into the trade down there, draw your fibs on this, and look where it went, right to the 1.382. Because the trend's down, you don't know if this is going to be where it stalls and continues its downtrend. But you can get into this trade down here at 106.53 with your stop at maybe 48. You're risking maybe 7 or 8 pips total, and this one went up almost 50 pips. 50 pip profit while risking 10 pips. That's 5 times bigger win than your risk. Obviously, it doesn't take a very high win rate when you're making 5 times on your winning trades more than what you're losing. Obviously, this is your average winning trade's not going to be 5 times, but that's certainly going to increase your average win. 5 times win here, another trade you have 1.5 times bigger profit than what your risk is. Another one you make half. As you know, some trades only make 5 pips. You have risk 10 pips. That's a half of a. Van Tharp in his Trade Your Way to Financial Freedom book calls these R multiples, risk multiples. So, you want your average risk multiple to be 1.5 to 2 times. So the next thing that you can do to add to your trading method is to put on the support resistance, because markets tend to stall at support resistance areas. And support, which is a buy area, once broken tends to become resistance, so you can find trades off of that. And for instance, if the price goes underneath yesterday's low by, let's say, 10 or 15 pips, and comes back up and touches it but can't get above it, that's a very safe, high probability place to sell it. So let's put these on your chart. Previous day's high and low, previous month's high and low, which I like to make thicker. The default is 4 pixels wide for those. And previous week's high and low. So you can see that one of the things that added to this probability of it going down was here's the previous day's low. It broke down underneath there. And starting the trading session last night, it went up to the previous day's high and wasn't able to break it. So one key factor in knowing which direction to trade is when you see a currency that's not strong enough to break through major support resistance areas, then if it's kind of chopping around and finally breaks down, it's probably more likely to go and break through the low. If it can't break through the high and there's not enough intensity of buying to push it through here, then it's likely to go low. And obviously it really helps to have the currency meter, let me put that up here, currency meter show you that the yen is the strongest one and the euro is quite weak. When that is the case, you have what you see here, down, you have a pullback here, and then down. Now, other support resistance areas that you'd want to add on your chart, I like to see the pivots. We have recently added the capability of the daily and weekly and monthly pivots to show these lines on the left side of the chart. Most of us, when we're trading, we're watching the right-hand side of the chart. If you put all these support resistance areas on your chart, you're going to tend to be inundated with so much stuff that you might be confused. But having these numbers on your left, at least you can look over and see where they're at. So if you just add it to the chart with 100 width, it's going to showcase it across the whole chart. If you want to see only 20% of the chart's width, but you want it on the left-hand side, you put in -20. If you want to see that line on the right-hand side, you don't put the minus. And so there you go. You can see that these are areas of support resistance. And most days, price does not go below second support level or above second resistance level, which we call R2 and S2. S stands for support, R is resistance. And S3 is usually the maximum low. That's why when it hit this level here, you can see it went up 30 pips. Not a bad place to do a counter trend trade. And anytime it's below S3, usually it's going to bounce off the Fib targets, which is another reason to have looked to do a counter trend trade down there. You made 30 pips here, you made 50 pips here. Doing counter trend trades in one of the weakest currencies. So that's, again, obviously a much more advanced method, but you can see the possibilities. The more you learn, the more trades you're going to spot in real time, and the more, you should do better trading. So I always like to put the monthly and the weeklies on there also. Monthlies I will put about 60% width. I like to make them wide, 40 pips. and then the weeklies maybe 30% width of the whole chart. So this is a support area right here. It was S2. It was a monthly S1 pivot. We have the weekly pivot, which is the average price. The white one's always the most strong, significant support resistance. And as far as the daily pivot goes, when it's above the daily pivot, it's more likely to trend up. When it's underneath the daily pivot, it's more likely to trend down. Same thing with the hourly moving average. Both of these in today's euro-yen example were right around each other. So when it came back down after 4:30 underneath the hourly, underneath the daily pivot, that's what began this big trend. One last thing I would like to add to this chart. Most traders are going to use our build your own trend currency meter to see the real-time momentum, but it's very important that you use our trading zones, because I spend about 30 or 40 minutes every night doing Fibonacci analysis and for my own trading, and I put it up on the server and it downloads it and puts it right onto your software for you. So this is a Fibonacci retracement level that's very likely to be support. The fact that it broke through that level proves how weak this currency is. And when you saw the counter trend trade right here, it adds to the probability. Anytime a fib area gets broken without even hitting it and going sideways first, and there's no buying there. That just proves how weak this currency is. Now let's look at, I left this running overnight for our class on another chart. Let me bring up the euro-yen on here. And you can see what it looks like when you have all the tools. The build your own trend tools, it started to trend down. You can see some intensity coming into the trade right here. It broke underneath the hourly, and when it broke down right here, you go short. You can use our intelligent trailing stop sign range charts to get out of trades as well. Notice this pullback right here. Almost no strength compared to the weakness. Pretty intuitive. I don't know if anyone watching this is not going to get that when you have extreme weakness on the way down and very little strength on the way up, that's what you want to look to sell. So I'm going to do probably at least one video every week for brand new traders to try to learn individual things that can help them trade, and over time add more and more and more sophisticated methods to the mix. Or one day I might show a simple method and add one thing to it, and maybe some other day show a different thing with that same simple method. And so you can add to your trading repertoire and become a much more advanced trader over time, but still have the confidence and know some very good ways of trading right away too, without feeling overwhelmed. Because honestly, it could take you 3 to 6 months of trading to see most types of days and most types of markets, and to learn by watching our videos and fully understand all the different trading methods that we teach.